Okay, welcome back to the Am I Rich Yet podcast, a weekly podcast where we help millennials and Gen Zs to grow, save, and spend their money smarter. Welcome to episode 11. We are on part 3 of our 5-part investing series. My name is Georgia. If you're new here, I'm one of your co-hosts. I'm a Gen Z myself, current MBA student, and navigating my personal finances. And who are you?
I'm Rob. I'm Georgia's dad. I am a recently retired financial advisor, and I'm here to help you make smart decisions with your money.
All right. And for our people that are watching this on YouTube and not just listening over audio, there's something really important that we have to call out here. And it is the fact that today you are dressed in one of your most stylish shirts I think you own. And I won't draw attention to the fact that it now makes me look like a slob in my little gray t-shirt, but tell me a bit about this. What's going on here?
Okay, there's a little story behind it. Today's discussion is around risk and risk capacity, risk profile, how much risk you're willing to take. When I was a young financial advisor, every time I brought in a new $100,000, I'd reward myself with a new tie. And I wasn't much into fashion at that time. And as I accumulated more ties, I started taking more risk with the ties. They became a little bolder, a little more fashionable. My outfits were still pretty conservative, white or blue shirt and gray slacks, something like that. But I could have some fun with the ties. So as I got older, I started experimenting with my wardrobe a little bit. And I was taking a risk. Every time I put that outfit on to try, I'm going out for the night, that's a little risky. What will the reaction be? So what's the reward? The reward, if I'm dressed really nicely, I get a personal reward. I feel better about myself. I have a little more confidence. Once I got out in public, I started getting people to acknowledge some of the guys. That's a great shirt you're wearing. That's a great blouse you're wearing. And then I see even members of the opposite sex might give me a glance or make a comment.
Whoa.
Wardrobe.
Mom's our producer here. Don't let her hear
But it was all about building confidence. So I've made it something that I do, and I have a lot of fun with it. And it makes shopping easier for me because when I go into a place, I just look for something colorful.
Yeah. I know.
There you go. So we're talking about returns and risk today. Those are the returns that I get from taking some risk with my wardrobe.
I love it. And I think you have some of the greatest fashion out of any man I ever... No, that didn't sound right. Out of all the men I know, you have some of the best fashion.
Thank you. Thank you, daughter.
But for our listeners, before they choke on their water when you say you wear a blouse, which, whatever, wear whatever you want, wear dresses, wear skirts, but you and your friend have a joke, right?
I've got a good buddy that we often play golf on Saturday mornings, and we'll see each other on the first tee, and we'll comment on each other's blouses for the day. Now,
I like it.
It's just sort of, we have some fun with it.
I like it.
And he's one of the more fashionable members of the course as well.
So let's hope he's listening.
So what are we covering today? We've got a lot of questions. We know we've been talking about risk. Let's bring the audience, Georgia, up to date on what we've covered so far in our series of podcasts.
So we know today is part 3 of the 5-part investment series. But looking backwards, our first episode, we talked about setting goals. We then covered budgeting over 2 episodes, episode 2 and 3. Debt and credit cards was covered in episode 4. Savings was covered in episodes 5, 6, 7, and 8. And here we are on investing.
So today in investing, what we're going to talk about is risk and returns. So I'm going to call this one of my golden nuggets I mentioned earlier on. Then I got these ideas that this is priceless. And you have to remember it. Risk and return are always related. If you believe that this investment doesn't have any risk, but has great return, I guarantee you've missed something. So let's use a simple analogy. Our old office was located on Yonge Street, and if you wanted to get to the other side of Yonge Street, there was 2 options. You could run across with cars coming north and south, or you could go down to the stoplight, wait for the light to turn green and cross. If you decided to take some risk and go directly across Yonge Street, regardless of the cars coming north and south, you would get there faster. There's a reward there. But there's a risk. There's a risk that you get hit by a car. If you go up to the light, The reward is less. It's going to take you quite a bit of time to walk around. The reward is less, but the risk is dramatically reduced because most cars stop at traffic lights. Make sense? Risk and reward. And often I'd have clients that come in, they'd have an investment idea, and they'd say, oh, I'm looking at investing in second mortgages. What do you think? I'm thinking of putting $100,000 in this. I said, you don't know the risk. The risk is it's a second mortgage. It's not a first mortgage. So there's always something that you're missing. Number two.
What is this number two? Another golden nugget.
I touched on it briefly. Speculating is not investing. It's speculating. It's a form of gambling. So let's look at some of the investments that I think are a form of gambling. More recent ones. GameStop. Okay? You're just gambling. You're just gambling that thing keeps going up or down. Cryptocurrency, I still believe is gambling. I don't think it's a legitimate currency. I can't buy anything with it yet. So I think it's a form of gambling. You're buying it because you think it'll just keep going up forever. Pot stocks. They came out, they were all the rage. It was speculating that I could buy low and sell high. And what's happened is most of that money was lost. Sporting events, betting on a sporting event. There's odds makers. They know what they're doing. You don't know what you're doing. You may think you know what you're doing. You don't have all the information. If you don't have all the information, you're speculating. And any sort of new issue, most new issues, a new issue is when a private company becomes a public company. And they do a big launch. They ring the bell on Wall Street. It's all exciting.
IPO.
And it's an IPO and it's $15 a share. And by the end of the first year, it's down to $10 a share, 9 out of 10 times. So just avoid that kind of stuff. If you want to gamble, do it differently. Go take $200 to Casino-Rama and go gamble, okay? That's just entertainment. If you take $2,000 to Casino-Rama, that's speculating. That's gambling. So I don't do gambling with my clients' money. I don't believe in it. I never want to tell them I lost money. Make sense?
I fear the haters are going to come out of the woodworks hearing that. I already have some people in my circles that do invest in those things and believe in cryptocurrency. I think we know that in this podcast, we're not going to talk about those things, so it maybe isn't the best podcast for them to listen to. Or maybe it is, and they should be open to new perspectives.
So Gen Z, I just saw it this morning, and it was a graph showing those from age 20 to 45, their belief in alternative asset classes, and those who are 45 and older and their belief. Those who are younger, 70% believe in alternative asset classes. And those are, whether it's infrastructure, whether it's utilities, whether it's private equity, all of the things like that. And why that's happened is a lot of the pension plans started to put some of that, what they call alternative investments into their portfolio. And now they're pulling out of it because they realize it hasn't delivered good returns. Whereas the older crowd who have more experience investing, they trust traditional investments, stocks, bonds, real estate. Why do they trust them? Think of how we live our life. Do you live your life with cryptocurrency?
No.
But do you shop at different retailers? Do you buy groceries? Do you use services of different companies?
Yes.
Those companies are big. They employ thousands of people, some of them tens of thousands of people. And their goal, every time they go to work, is to make a profit. And if you buy into those companies, you own some of the great companies around the world, and you get to share in those profits. There's nothing alternative about that. A mentor of mine once said, alternative to what? Equity investments, fixed investments, stocks, bonds, etc., are liquid investments. Some of them are guaranteed on the fixed side. Some of them are not guaranteed on the equity side, but investing in Amazon is a pretty good bet these days, okay? Regardless of what the stock price is. The company's not going anywhere tomorrow. Yeah, they're going to face stiffer and stiffer competition, and they already are. But investing in some of those companies is a pretty safe, secure bet, okay? I know there's some haters. There's going to be people who love to speculate and gamble with their money, trying to hit a home run. No, just hit singles and doubles. Think of it as baseball.
I like that.
How to build real wealth over time. After taxes and inflation, you need to have money left over. And the only way to do that is to have growth investments in your portfolio. So I'm going to give some examples. Let's start. I'm going to say after taxes and inflation, you need to have an extra 1 to 4% return every year. Okay. So let's say you're getting a 6% return.
Now pause.
Oh, we're going to cover some math, right?
Yeah.
I forgot.
We're getting mathematical. We're going to be talking about some numbers. So if you're driving, pull over. If you're sitting, whip out your notes app. And if you're just listening or you don't care about the numbers, buzz right through this. Let's go.
Okay. So we're going to say that inflation is 3%. That's what it's been for the last 100 years. We'll call it 3%.
Great.
Today it's a little higher in the US. It's a little lower in Canada, but let's call it 3%. We're going to say that you're paying a fee to have your money managed. You're working with an advisor and that fee is 1%. And then we're going to say you're going to have to pay some taxes. Maybe you're going to pay a third of your return in taxes. So inflation at 3, 1% fee, a third of your return in taxes. 6% return. After tax, it's a 4% return. After inflation, it's a 1% return. And now you're paying an advisor 1%. What are you left with?
0.
You got it. Okay. Now let's go to a 7% return.
Okay.
Same math. Your 1% fee, 3% inflation. You're left with 3%. And you're paying taxes at 2.4. You're making 0.6% a year. Even if you take the advisor out of the equation, you're still only making 1.6% after taxes and inflation.
1.6 or 0.6?
Take the advisor out, you're making
Got
1.6.
it.
Put the advisor, you're making 0.6. And if you go up to 8% return, which is a pretty good return, take away that fee, take away taxes, you're only left with a little bit more, 1.2 or 2.2%. Even when you go to a 9% return, now you're starting to look at better returns. You're at 1.8. Your money's actually growing after taxes and inflation. So when people look at investments, you've got to take some of that into account. Now, let's explore what is the expected return for different types of investments. Okay, long-term historical returns. Cash, high-interest savings. Typically 1.5 to 2.5% a year.
So we're going to cover the six
main categories.
6 asset classes that we covered in our previous episode.
1.5 to 2.5% a year. GICs, we're going to say 2 to 4% a year. Still very low returns. Government bonds, a little bit better, 4 to 7% return. Maybe even 4 to 5% return. Stocks, somewhere between 7 and 10% over time. 10% a year, 7% a year on the low side. Equity mutual funds, a little bit lower, somewhere between 6 and 9%. And then if we look at ETFs, because their fees are typically lower, we're going to say 7 to 10%. So right away, you can see where the extra returns are.
Yeah.
They're on the equity side, the real estate, the mutual funds, the ETFs, or stock ownership. And that's why I'm trying to push you that way. Remember, we're not speculating. We're investing, and there's a big difference. There's a common portfolio that investors always talk about. It's the 60-40 portfolio. And every year, there'll be an article that says the 60-40 portfolio is dead because they're looking at the last 6 months. And then 9 months later, oh, the 60-40 portfolio is back in vogue. It's actually a great portfolio. It's called a balanced portfolio with 60% stocks, 40% bonds. But I think you can do better than that. And that's what we're going to push you towards.
Awesome.
Any questions so far?
No. Why don't you just quickly recap out of those asset classes, what is on the lowest end and say them sequentially to the...
Low end is cash, then GICs, then bonds. On the higher end is equity mutual funds, stocks, equity ETFs, and real estate.
Awesome.
Why doesn't everyone invest in stocks? Why don't we just put 100% in stocks and call it a day? It's a bumpy ride. And I talked about this in an earlier podcast. Every year, the stock market goes down roughly 15%. And every 5 years, it's going to go down roughly 30%. And every 8 to 10 years, it may go down 50%. It can be a bumpy ride and it's scary. And, at one point in 2008, That was even too much for me. The market was down at one point 60%, the world stock market. But if you looked at it logically, how could all the value of all the publicly traded companies in the world be down 60%? It didn't make sense. People were still driving to work. They were still eating groceries, going out to restaurants. The planes were still full. It didn't make any sense. And sure enough, it recovered. And you just have to remember that it's a temporary decline. And it's all because people got scared. Right now, there's some battles going on between Russia and Ukraine, and between Israel and Hamas, and now Israel and the US and Iran. And so the market is fluctuating a fair bit. This too shall pass. We'll have something else to worry about 6 months from now. We'll even forget that this all happened, hopefully. And even if it continues on, look at how long the war in Russia has been going on. Hasn't caused the stock market to crash. The market's gone straight up. As a young investor, or for our audience, you should be at least 80% in equities, probably at 100%. And if you have trouble staying there, you probably need an advisor to help keep you there. Little tip here, if you're working with an advisor, ask them what their portfolio is. If they're a conservative advisor, they're going to put you into a conservative portfolio. So you might want to shy away from those. And I mean that honestly. They're going to earn lower returns. Their clients are going to have less money over time. That's the math. And advisors' clients' portfolios often mimic their own. Okay? What to look for? Here's my 5 things to look for.
Pause. Before we go into that, what if you weren't working with an advisor?
So let's say you're working with a robo-advisor, or you're with a bank, and you're using their trading platform to trade. These next rules will apply.
Awesome.
Okay? But I still think you should be 80 to 100% in equities. Often you're going to be lower because the bank may have pushed you that way, or the robo-advisor may have pushed you that way, and I think it's a mistake. Remember how, and we're going to talk about that a little bit, but there's a conflict of interest between these robo-advisors and trading platforms. And this is just what's happened. When they started, they were building beautiful, globally diversified portfolios. And they were spending a ton of money advertising. And what they quickly figured out is they couldn't make any profits. So what they had to do is they had to shift. First shift they did is they moved to all their own products. So that made them a little more money. And then what they started to do is they started to make it easier to trade. And they made trading no cost for trading. So how can they be running a business if they're not charging anything? They're making money on the trading. They're making money on the cash balances. And I'm not going to say it's evil. They're trying to run a business. They claim to be trying to help young people. And some of that was initially there. But the more you trade, the less money you have. The joke it's like a bar of soap. The more you play with it, the less the money you have. The more you trade, the less the money you have.
I like that soap analogy.
Okay.
And that's good perspective. But for people that are using robo-advisors like Wealth Simple, etc., is it horrible, stop using it, get out? Or is it like just be aware of the tool you're using and maybe forward looking, look into what your other options are?
Here's what I would say. Always look at what are they doing? Mm-hmm. I talked about Uber with all their advertising and sports gambling and all their advertising. How are they paying for all that? How is Questrade and Wealth Simple paying for all that advertising they're doing? They got beautiful ads. They got great ads, hitting at Dad's Advisor and whatever else. How are they making all that money if they're doing everything for free? Something doesn't add up. They're not a nonprofit organization.
But we still use Uber.
No, we do. But again, it's expensive. So, like any season 1 of a new podcast, there's bound to be a few errors. So as many of you know, Georgia is now back in Australia. So it would be difficult for us to fix a podcast where we had issues. Well, this is the only podcast we've had big issues. And it's episode 11. With the help of a friend down in Canada, a friend named Jerome, he was able to bring our video back to life. But it had some shortfalls. It was missing the last couple of minutes. So I'm here to fill those in. So where we had left off, we'd just been talking about, robo-advisors and doing it yourself, etc. And the next stage I was going to talk about was, what are some of the things you should look for in building your portfolio? So let's get started. Number one, it needs to be extremely diversified. I want it to hold at least 10,000 companies or more, diversified around the world. More company, the better the diversification, the lower the risk. In theory, the better the risk-adjusted return. Number two, it should be a mutual fund or an exchange-traded fund or ETF. Number three, that mutual fund or ETF, the fees need to be at least 30 basis points or less. Anything more than that, and you're probably not getting good value. I said invested around the world. You might have a bias towards Canadian companies, and that's fine. Might be 25, 30% Canadian. I wouldn't want to see it 60% Canadian. That's too much in Canada. But we do live, every investor has a home bias around the world. And finally, I want the investment to be 100% liquid. And that's why it's key to be in an ETF or a mutual fund. So those are the things to look out for when you're trying to pick the first fund. I'm not going to name any specifically, but you can do your own research there to determine which are the best. And if you have any questions, feel free to reach out to us and we can respond. So in closing, what we've covered today are, number one, risk and return are always related. Don't forget that rule. If you see a higher return, there has to be a higher risk associated with it. You just may not know what that risk is. Number two, speculation is a waste of time and money. Invest your money. Don't speculate with it. Next episode, what are we going to cover? We're going to go back to your question. Lots of great questions on investing. We're going to cover that in our next episode. So that's it for episode 11. We look forward to seeing you back to episode 12. Have a great one.